Welcome to the deep dive. Today, we're taking a really focused look at Bajaj Finance, specifically their Q4 results for fiscal year 25.
That's right. We've got the official numbers, the investor slides, and importantly, the recording from their conference call,
Yeah.
where the analysts really dig in.
Exactly. So we've got quite a bit to work with, and our mission really is to cut through all that data and pull out the key insights for you. What does it all actually mean for Bajaj Finance and maybe the wider financial sector?
Yeah, try to connect the dots. You get the hard numbers, then the company's narrative, and then the back and forth on the call. It gives you a much fuller picture than just looking at one source alone.
Okay, let's jump right in then. Those headline numbers for the quarter ending March 31st, 2025, net profit.
Solid. Up 19% compared to last year. That's 4,546 crore.
Okay, 19%. And profit before tax, PBT.
That grew 11% year on year, hitting 5,647 crore. But important to note, there were a couple of one-off things impacting that number. We should probably unpack those.
We definitely will. And what about the loan book, assets under management, AUM?
Big growth there, too. Up 26% year on year. We're talking 416,661 crore in total AUM now. Just massive scale.
Wow. And that growth must be fueled by loan bookings?
Absolutely. They booked a record 10.7 million loans just in Q4.
10.7 million in 3 months.
Yeah. And they keep pulling in new customers, too. 4.7 million added in the quarter. Their total franchise is now over 101 million people.
That's incredible reach, and the app usage reflect that, too.
It does. Almost 71 million users on the Bajaj Finserv app. It really shows you just how embedded they are digitally.
So all that volume, the loan bookings, that clearly drove top-line growth.
Right. Net total income was up 22% year on year for the quarter. That's on a consolidated basis. So yeah, good quarter on the volume front.
Okay. Now, profitability. You mentioned the PBT had those one-time items. How did the core profitability metrics look? ROA, ROE.
So return on assets, ROA was 4.6%.
Mm-hmm.
And return on equity, ROE, landed at 19.1%.
19.1% ROE. Still strong, but isn't that a bit lower than, say, the same time last year?
It is, yeah. Good catch. It was 20.5% in Q4 of FY24. So a slight dip.
Any thoughts on why? Competition? Investment?
Could be a mix of things. Maybe competitive pressure. Maybe they're spending more on tech, like that digital push we'll talk about. Or, sometimes rapid growth itself can temporarily squeeze margins. Management seemed happy with volumes and efficiency, but they did flag those one-offs affecting the bottom line.
Right. Let's dig into those one-offs then. What were they exactly?
Okay, so the first one was an extra provision for expected credit loss, or ECL, an additional 359 crore.
And that was tied to their annual model update.
Exactly. Think of it like tweaking their risk prediction models based on recent data. They saw higher, let's say, flow-forward rates loans moving into riskier categories and generally higher credit costs over the last 3 quarters.
So they're adjusting their predictions based on that recent experience.
Precisely. It mainly impacts what they call Stage 1 assets loans that are okay now but have some potential future risk. It's them being more cautious, more forward-looking.
Makes sense. Proactive provisioning, even if it hits the P&L now.
Right. As someone on the analyst call pointed out, the model's essentially saying, hey, what we've seen lately might stick around for a bit. It builds a stronger buffer.
Okay, that was one item. What was the second?
The second was actually a positive one, sort of, a special interim dividend of euros per share.
Ah, and that came from the gain they made on the Bajaj Housing Finance IPO listing, right?
Correct. That exceptional gain funded that special dividend.
And alongside that, they're recommending a final dividend too.
They are 44 per share, though that needs shareholder approval, obviously.
Right.
And management made a point of saying this final dividend is about 19% of their standalone profit if you take out that IPO gain. Seemed to fit their usual pattern reward shareholders, but keep plenty for reinvestment.
Okay, let's shift back to growth. That 26% AUM jump, where's it coming from? Is it concentrated or broad?
It seems pretty broad-based, actually, across most of their lending businesses. They did highlight, though, particularly strong growth in newer secured stuff like gold loans.
Interesting. And what about their physical footprint? Are they still opening branches everywhere?
Less so now, it seems. Management kind of indicated the main geographic expansion is largely done. New branches are more targeted now.
Targeted towards?
Mainly gold loan locations and branches for microfinance MFI. They added, 137 standalone gold loan spots in Q4 alone, bringing that total near 970, and about 30 new MFI branches, too.
Got it. And the subsidiaries are contributing significantly to that overall AUM figure.
Oh, absolutely. Bajaj Housing Finance, BHFL, its AUM was also up 26%, reaching almost 115,000 crore.
In the securities arm, BFinSec?
Their margin trading facility, MTF, lending for stock trading, that saw an 18% AUM jump to about 4,500 crore.
So it's diversified growth. Core lending, housing finance, securities lending. It all adds up.
Exactly. It shows they can tap into different parts of the market effectively. Yeah. BHFL especially, operating in that specific housing finance space, seems to be doing very well.
All right, now for the critical question for any lender, asset quality. How are the loans performing? What about NPAs?
Okay, so gross non-performing assets, GNPA, came in at 0.96%.
0.96%. That's up a little from last year.
It is, yeah. Was 0.85% a year ago. And net NPA, that's after provisions, also ticked up slightly, from 0.37% to 0.44%.
Okay, a slight increase, but how does that compare?
Management was pretty quick to say it's still among the lowest net NPAs in the industry. So, yes, an increase, but from a very low base.
Right. Context matters.
And interestingly, they saw an increase in Stage 2 assets during the quarter. Those are loans showing early stress, but not yet NPA. But Stage 3 assets, the actual NPAs, they decreased.
Ah, so that extra ECL provision we talked about makes even more sense now. They're provisioning proactively against those potentially risky Stage 2 loans.
Exactly. It ties back to that cautious stance.
And the total credit cost figure for the quarter?
It was 2,329 crore. Now remember, that includes the extra 359 crore ECL provision.
So if you back that out, the sort of underlying loan loss
would be around 1,970 crore, which works out to about 1.97% of their average earning assets for the quarter.
Got it. And any specific segments they called out regarding asset quality? Like rural?
Yes, they mentioned rural BDC. Apparently, their model changes there didn't require extra provisions beyond what they already had. And they said the newer loans, the recent vintages, are actually performing better.
So some positive signs in rural lending.
Seems so. They sounded pretty confident about growth there, feeling they've strengthened their approach, particularly on the debt management side, learning from the past, perhaps.
Okay, let's pivot to the digital side. They're making a big deal about this finite transformation, right? AI everywhere.
Oh, absolutely. It's clearly a massive strategic push, integrating AI across, well, pretty much everything.
What are the targets?
They're aiming to deploy around 100 AI applications just in the next fiscal year, FY26.
100? Wow. Across which areas?
Revenue generation, cost cutting, customer engagement, underwriting loans, boosting productivity, even internal controls. It's ambitious.
They're really betting on AI to drive efficiency and growth then, becoming an AI finance company, as they put it.
Exactly. It's a major investment. It'll be fascinating to see how that translates into actual metric improvements over the next year or so.
And the customer-facing tech, the app.
Still growing strongly. As we said, over 70 million users on the Bajaj FinServe app. But they're also stressing their physical presence, their omnipresence.
Right, the branches and distribution points.
Yeah, over 4,200 locations, more than 230,000 active distribution points. But like we discussed, the new physical expansion is very focused now, gold loans and MFI.
And customer acquisition overall remains strong.
Very strong. 4.7 million new customers in Q4, over 18 million for the full year FY25. And their cross-sell number is huge too.
And
Nearly 65 million customers have more than one product with them.
That shows they're good at not just getting customers, but keeping them and selling them more stuff.
Definitely. Deepening those relationships is key.
Okay, funding all this growth. How's their liquidity and cost of funds looking?
Liquidity looks very comfortable. Their liquidity coverage ratio, LCR, is way above requirements, over 288% on a standalone basis.
Plenty of cash on hand for short-term needs.
And cost of funds came in at 7.99% for the quarter. That's up slightly.
Any outlook on that?
Yeah, they actually expect it to ease a bit. They're guiding for it to gradually decrease, maybe into the 7.75% to 7.85% range by the end of FY26.
Interesting. And capital adequacy. Do they have enough capital buffer for this growth and risk?
Looks very solid. Capital adequacy ratio, CAR, is nearly 22% standalone. Tier 1 capital, the real core stuff, is over 21%. That's comfortably above regulatory needs and supports their growth plans.
And are people still putting money into their deposits?
Yep, deposits are growing steadily, up 19% year-on-year standalone, 20% consolidated. Shows continued confidence from depositors.
All right, let's talk outlook. How did management sum up the year just gone, FY25, and what are they projecting for FY26?
They called FY25 kind of a mixed bag. Good on volumes, AUM growth, customer acquisition, operating efficiency, even pre-provision profit was strong.
Right.
But As we discussed, those credit costs were higher than they'd hoped. That put a damper on overall profit growth. They basically acknowledged they missed their own assessment on credit costs for the year.
Okay, so a bit of a reality check on credit costs. What's the vibe for FY26 then?
More upbeat on profit growth, I'd say.
Yeah.
They're setting some clear targets,
Like customer growth.
targeting 14, 15 million new customers,
Yeah, AUM growth.
aiming for 24, 25%, still very strong.
What about margins?
NIM,
They expect net interest margin, NIM, to be broadly stable. The thinking is that slight decrease they expect in funding costs.
the 7.75, 7.85% range.
Right. That should be mostly offset by maybe slightly lower yields on some unsecured loans, probably due to competition, maybe some pricing adjustments. They're forecasting 13-15% growth in fees and other income. But they did mention that's moderated a bit because of fee adjustments and stopping those co-branded credit cards. Okay. And efficiency. Are they expecting improvements there?
Yes, definitely.
Yeah.
Targeting a 40 to 50 basis point improvement in their OPEX to NTI ratio. That's directly linked to that finite AI transformation stuff we talked about. Hoping for real operational leverage.
Makes sense. And the big one, credit costs for FY26. What's the guidance?
They've put a corridor out there. Loan loss to average earning assets between 1.85% and 1.95%.
So slightly lower than the underlying rate in Q4, but maybe acknowledging it won't snap back immediately.
Seems that way. It's a bit higher than what they might have initially aimed for in FY25, reflecting that caution.
And overall profitability, ROA, ROE targets.
ROA expected between 4.4% and 4.6%, ROE between 19% and 20%. They did note the ROE is still a bit suppressed by the excess capital they're carrying.
And NTAs.
Expected to remain low, below their long-term guidance levels.
Interesting. Did they tweak any long-term guidance?
Just slightly. Widen the ROA range a touch to 4.3, 4.7%, and revise the ROE range down slightly to 19-21%.
Yeah.
Maybe just reflecting the current environment.
Okay. And just to quickly recap, the subsidiaries BHFL and BFinSec both had good quarters.
Yes, very much so. BHFL, the housing finance arm, saw strong AUM growth, 26%, and really strong profit growth, up 54%. Asset quality there looks excellent too, very low NPAs.
And BFinSec.
The securities arm, particularly the MTF business, also showed good growth across the board, AUM, profit, customers. So yeah, the subsidiaries are definitely pulling their weight.
Got it. Were there any other kind of key updates or news items?
A few things. They appointed 3 new deputy CEOs.
Oh, interesting. Why?
They said it's to manage different business clusters, basically reflecting how big and complex the company has become, spreading the load, managing growth.
Sensible. Anything else?
They made a strategic investment, took a 12% stake in a cybersecurity firm called Protect.ai.
Ah, bolstering their tech defenses.
Seems like it. Cost them about 65 crore. Clearly focused on protecting their systems and data, especially with that digital push.
Good move. And one more thing.
Yeah, S&P upgraded their standalone credit outlook. It's now BBB, with a positive outlook, so a nod of confidence from the rating agency.
Okay, so management changes, cybersecurity investment, rating upgrade, paints a picture of a company managing growth and risk.
I think so. Preparing for the future, trying to stay ahead of the curve.
Now, finally, that analyst Q&A session, what were some of the key themes or interesting exchanges there?
Well, there was definitely talk about market share. Management kind of argued that because their share is still relatively small in many areas, there's just a long runway for growth ahead.
So plenty of room to expand without bumping into limits.
That was their argument. They also went into more detail on that ECL model refresh, explaining why the provision went up based on recent trends.
Did they give any hope of that reversing?
They did suggest that if credit performance improves like they expect it to, some of those provisions could potentially be released down the line, which would obviously help profits.
Okay, what about specific segments, like rural?
They reiterated their comfort there, pointed to those improving early loan vintages and better debt management capabilities they've built, felt they had a handle on it.
So the overall message from the Q&A, balancing growth and risk?
Very much so. A lot of focus on hitting that 1.85, 1.95% credit cost corridor in FY26. That seems paramount. And using operating leverage, cost control and that AI transformation to help drive profitability while managing the credit side carefully.
Did analysts push back on that credit cost guidance being maybe a bit higher than hoped for?
Yeah, there was some discussion there. Management essentially said it was a prudent stance. They want to see how the existing unsecured loan book matures before getting overly aggressive again. They actually suggested credit costs might be better in the second half of FY26 than the first.
Okay, so manage costs first, then maybe accelerate again later if things look good.
That seemed to be the underlying message. Get firmly within the guided range before pushing the growth pedal too hard again.
All right, so wrapping up this deep dive, what are the main takeaways for you? Strong growth continues.
Definitely. AUM and customer numbers are impressive, but paired with a clearly more cautious stance on credit costs.
Leading to that refined profit outlook for FY26. Still optimistic, but maybe tempered realism.
Exactly. And underpinning it all are those big bets on digital transformation and AI, plus solid performance from BHFL and the FinSecs.
It really feels like that tension between growth and risk management is front and center right now.
It is, and how well they navigate that. Specifically hitting those improved credit cost numbers in FY26, that's going to be the key thing for everyone to watch, I think.
Okay, here's a final thought for you, the learner, to chew on. How might the bigger picture, things like interest rate movements, overall economic health, and just the sheer intensity of competition in digital lending, how might those external factors affect Bajaj Finance's ability to hit their FY26 targets, especially those crucial credit cost and NI goals? And what could provide tailwinds or maybe headwinds for that big finite strategy they're rolling out? Something to think about.
Good question to ponder. The internal strategy is one thing, the external environment is another.
Absolutely. Well, that brings our deep dive into Bajaj Finance's Q4 FY25 results to a close. Thanks for joining us.